Good morning, everybody. Thank you very much. Thank you for coming on this very nice sunny day to our August update. We're anticipating this being quite a quiet one, given that it's August and anyone in their right mind is on holiday enjoying some of the sun, but we seem to have this for once in the UK. For those of you that are here for the first time, we're going to stick with the usual format. So we're going to run through very, very briefly some of the performance that we've seen in the portfolios, talk a little bit about the positioning, very brief overview of the equity markets. I've got Jeff, two down from me, who's going to talk through the fixed income side, and then Joseph, who's right next to me, who's going to focus on the cannabis industry. I don't know how many have turned up just to hear about cannabis, because it does seem to be quite a popular topic. We are going to try and push through all of this in about 45 minutes. If we're quick, maybe 40, and then we'll have some time for questions and answers at the end. And yeah, when we've done a couple of these before, the cannabis topic does seem to have raised quite a few questions. But we'll, kick straight on. Just in terms of the concept behind what we're trying to do at a portfolio level, we're running primarily absolute return focused portfolios. So the idea for our clients is that we're trying to avoid some of the market pullbacks that we've seen thanks to Trump in the last week and a half. So what we are trying to do is not hold equity exposure just for the sake of holding equity exposure. We want to take equity exposure when we think that the risk reward balance is skewed more in our favor, rather than just sitting and owning market beta and importing volatility into client portfolios. So the concept and what we're looking out into the second half of 2019, we think is going to be more of the same. So we went through the entirety of July with circa 3 to 4% of equity exposure in some of our conservative portfolios. Even the growth portfolios were sitting around about 7 to 8%. Right at the end of the month, when we started to see markets sell off because we had that 6% pullback, we increased to about roughly a third of our equity exposure. So even right now, our conservative portfolios have been sitting at sort of circa 9, nearly 10% of equities. The idea here is to try and generate these consistent returns rather than trying to ride the markets up and down. When we're looking forward over the next 5 to 6 months, we do think we're going to see more back and forth between Trump and China. Obviously, we've got this little thing called Brexit that we're looking at from the UK's perspective. So we are going to see some volatility from emerging markets in the US, ditto in the UK and Europe. So we're going to be continuing this nimble in and out of markets depending on where we think we're currently positioned and why. On the fixed income side, I'm not going to steal too much of Jeff's thunder, but we are also actively managing the fixed income. So we're looking both at the yield curve positioning, how we want to be sat on the curve across euros, dollars, and sterling. We are using duration hedging. We can take credit risk when we want to. And the idea is, again, that we take the exposure that we want and eradicate the exposure that we don't. So for dollars and euros, we took out all of the duration. We went to zero duration and just took out the credit risk that we wanted. In dollars, that hurt us to some extent. I know it looks slightly bizarre seeing 3 different models of conservative, balanced, and growth, all with almost identical performance. That was because we had almost no equity exposure. And when we saw the 10-year US yield break below 205, and then it broke 2, and then we became neutral from a duration perspective. Now we're trading down sub 170, which we think is way too fast. So now we've gone short duration on the fixed income side in dollars and euros. So just to push straight through into equities, we're obviously keeping going with our MVST model. So from a macro perspective, we have seen some of our model numbers start to change as we're pulling through some of the underlying macroeconomic data. Our positioning, as I said, what we've been doing at a portfolio level changes significantly month to month. What we're doing from a geographic and allocation perspective hasn't been changing too much. So most of our exposure is currently sat in the US. We have been picking up a little bit of emerging market and a very small amount of UK exposure and Japanese equities in some clients. But our big focus that we have been sat on was when the S&P 500 was above 3,000, thinking that actually this is too high. We've rallied too quickly. The earnings revisions, which we've seen in the US at the top left, we can see the 2019 earnings revisions coming down. We did see on earnings season a beat, a fairly strong beat on the US across the board, especially on the earnings side, but that was done on the back of revised down expectations and actually announcements from companies. And we can already start to see some of the 2020 earnings figures slowly sliding, even when we're only in the summer of 2019. Interestingly, when we're looking across the globe, we're seeing exactly the same pattern in Europe, the same pattern in Japan. The only one that's standing out as actually having upward revised earnings is the UK, but that would be more a function of currency than anything else. That's obviously subject with a big asterisk in terms of what is going to happen on the 31st of October. We've deliberately tried to not cover Brexit in here because we're trying to look at things from a global perspective. We did host a Brexit breakfast about a week ago, and we had a couple of MPs in our office talking about Brexit. The Conservative MP was absolutely convinced that we are going to have Brexit on the 31st of October. Obviously, he has no idea whether that's going to be with a deal or without a deal, but he was 100% convinced that there will be Brexit on the 31st of October. We are in a situation where we're looking at Boris Johnson playing this game of chicken with Europe because he has to have them believe that we will leave with or without a deal on the 31st of October. Similar sort of relationship being played out between Trump and China at the moment. But just on the equity side, we saw a positive season, but given that it was coming on the back of revised expectations, we were not buyers, so we would rather just sit on the sidelines, watch and wait, and that was across the board. And then we can see the drop that's happened at the end. Obviously, we've had little bouts in the last couple of days, but that was a 4-day, 6% peak to trough pullback, and we avoided circa sort of 90% of that. That should, just on the sentiment side, because we are feeding through the macroeconomic environment, we're looking at company valuations, sentiment and technicals are the other two components of that. We have seen, as you can see highlighted with the green circles, a little bit of a change from a sentiment perspective feeding through in both the US and Europe. And we were pulling through on both of those when we did increase our exposure, so pulling that through into our models. Briefly, before I pass on to Jeff, and then you can get a change in my droning voice. The thematic ideas, that's been one of the few additions that we did make earlier on in July. We pulled through 4 separate stocks into the portfolio. Two of those were related to our video games concept. We had the interesting news afterwards when we had a $1 million prize winner in the UK and another one in the US. And suddenly, after we published this, after we put some of the stocks in, we then started to have, everywhere we looked was more news on esports and more prize monies and record prize pools, right up until the mass shootings in the US, which Trump then tried to blame onto video games. We had an interesting conversation in the office about the amount of video games that are played in South Korea, but the lack of mass shootings that seem to happen in South Korea. But he can't seem to put that two together. So that was one side of the thematic ideas that we implemented. The other one was more looking at the European autos. So this falls into the defensive play. Although Europe from a macroeconomic perspective looks weak, it has the Brexit overhang. We've started to pick up a couple of small stocks that we think look interesting from a cash flow and dividend paying perspective. So just in terms of how some of these themes have been performing year on year, our biggest and most complex theme is the emerging market consumer, which is also the one that is performing the best versus the emerging markets index. And we're in the process of implementing another couple of stocks into the portfolio on the EM consumer theme, but there's so many different sub-themes that fall into that. Online life is one of those sub-themes, but not exclusive to the EM consumer, and video games obviously has a big overlap with the EM consumer. that's probably enough for me for now. So I'm going to pass you over to Jeff.
Great. Thank you, Simon. We just want to start by discussing our position across each segment of the fixed income markets, which we break down by region and also curve positioning. Most notably, since the end of last month, we've changed our position on Euro government bonds due to the unattractive negative yields. The German curve is now negative yielding right across the curve. And as of this morning, the most actively traded 10-year bond is yielding negative 55 basis points. So that's following behind other sovereign debt, including Switzerland, Denmark, and Netherlands, paper issued out of those countries. So just to throw a factoid in there, there's now a staggering $14 trillion worth of debt issued by governments and companies around the world that's negative yielding. So we've updated our positioning based on the cut by the rate cut by the Fed by a quarter point last week, and also with government bond having rallied in sympathy with this, and also the dovish tone that we've been hearing from other central banks, we think this is the right time to be short duration in fixed income. So that's treasuries. And we are now overweight on short duration part of the curve in US and UK government bonds. Credit markets rallied last month on the expectations of a rate cut, but a lot has happened since month end. And I'll go through how we want to be positioned as a result of that. So turning to central banks, last week we saw the US Federal Reserve Chairman Jerome Powell. He made a much anticipated announcement to cut rates by a quarter point and also stop shrinking the balance sheet. This was broadly in line with our expectations that the Fed would enter a new regime and act as a risk manager and make an insurance cut to protect the US economy from downside risks as they pertain to global trade tensions. And if you think about the Fed's dual mandate, which is to one, maximize employment, and two, keep prices stable, we think this cut was wholly unnecessary, considering that one, unemployment is at a record low. Secondly, wages are growing at a decent pace. You've seen decent job gains, and economic growth remains stable. It's expected to be in that plus 2% area. The only spot of weakness we really see is in manufacturing. That's the only economic data point that stands out to us. So if we think about the four moving parts in the story, you've got Chinese tariffs, which has the effect of importing inflation. So the Fed could respond to that by raising rates if inflation goes beyond the 2% target. There's also the trade war, which could potentially dampen GDP growth and prompt a rate cut. There's the strength of the labor market, which we don't think would warrant a cut. Thanks, Joe. And finally, the point of independence at the Federal Reserve. The Fed's now at a dangerous juncture, and it's being bullied into a corner by Trump, and it's at risk of losing its independence and credibility and losing its flexibility to cut rates in the event it does actually take a significant downward turn. So we're watching as China, the Fed, and Trump play out this game of chicken. But weighing up all of those factors, we don't think that, well, we think that markets are pricing in a deep rate cut. We're talking about 75 basis points before the end of the year, which we just simply don't think is justified. And we think the rally in treasuries has been completely overdone, and they will retrace to lower levels. So we're looking for an entry point on that basis, and we're shorter duration in treasuries for the time being. And as I mentioned, the weak spot in US economic data has been in manufacturing. Here, I'm looking at the ISM manufacturing PMI index, which is one forward indicator for economic health of the US, and it has retrenched and pulled back to below the 50 level. And you can see that the 10-year US Treasury trades with strong correlation to this index, and the latest data point has largely been priced in. And again, we think the markets are totally overreacting, and 10-year yields should not be trading inside 1.7%, which it has been over the past couple of days. Thoughts on valuation. So please note that the chart data here refers to the month end, and a lot has happened since then. But at the end of July, The point that stands out the most to us is European credit looking particularly expensive. It was over a standard deviation expensive using a 90-day rolling basis method that we look at. And the reason for this, well, the markets were expecting a fresh stimulus. You had Draghi, he came out and spoke at a press conference. He essentially poured cold water over any hopes that the Eurozone would recover in the second half of the year. And I contribute this to one, inflation. So the official estimates of inflation were revised downwards following market-based inflation expectations. Second, the trajectory for manufacturing, which is looking worse and worse in the words of Draghi. He says that for the countries where manufacturing matters the most, it's just getting worse and worse. And then third factor is that with the appointment of Boris Johnson as Prime Minister, the prospect of a disorderly Brexit, that probability it's been rising and rising. So with the combination of these three factors, I think that the likelihood that the ECB will take action and restart its asset purchase program in September is all the more likely, or at least before the end of the year. But that picture has changed somewhat. If we focus now, if we turn to the US, I won't speak too much about this slide since this doesn't reflect current valuations, but what that table on the left does illustrate is that how fixed income was very unattractive. Valuations were simply not very compelling at the end of last month. And we were right to remain disciplined and stay out of credit during that. And you can see by that swathe of red on the table on the left, it wasn't the place that we want to be. But we have rerun those numbers and following the sell-off over the last week, and US high yield now appears 1.5 standard deviations cheap, and US investment grade as a whole is 2 standard deviations cheap. And our sweet spot, which was the AA 3 to 5 year segment of the market, we said that looked attractive at the end of the June, and it looks like that's coming back into play again. So just to give a better sense of trading levels of where we are now, if you dip down from treasuries into investment grade, you get on average a 1.25% pickup. And if you dip down to high yield, dipping further down the credit spectrum, you're getting about 4.5%. So you get a decent pickup versus treasuries. So high yield, we think, is back in play again. And it's a decent place that we're waiting for that to see if we can find an even more attractive entry point. And now turning from valuations to fundamentals. So we've had a lot of commentary said and written about the health of the high yield market as we approach the end of the credit cycle. So here I wanted to provide my own 2 cents and form our own house view. So you can see that over the last 5-year period, net leverage, which is what credit investors, it's one of those metrics that credit investors focus mostly on, it's only crept up slightly to about 3.7 times. And it's going to take a lot more debt excess and EBITDA pressure for it to really trouble us. If you look at the lighter blue line, that's the upper quartile of the US high yield universe. And you can see that's broadly been stable in that sort of 1.5 times region. And that's mostly made up of solid BB rated companies with stable operating profiles and strong credit metrics, which were also the most resilient part of the high yield index during the sell-offs in the fourth quarter of last year, and also in the mini sell-off that we saw in May, just gone. Names that stand out in that segment of the market are defensive healthcare names like HCA and also IQVIA, which have exhibited lower volatility. And given that though, you only get about a 50 basis point from pickup from trade by dipping down into that region. So it's all depending on the risk constraints of the portfolio, how much further you want to dip down. If we look at the dark blue line at the top, that's the part of the market that is more of a cause for concern for us, where you've seen more of a significant deterioration of balance sheet strength, with leverage climbing quite steadily. And the contribution to this has mostly come from capex intensive pro-cyclical sectors like energy, particularly oilfield services, the basic industries, and well. One name that stands out as a good example is Weatherford. You might know the name. They were burning cash for consecutive years. They had 10 times debt to EBITDA. And even though they were paying pretty attractive yields of 10 to 15% yield, depending on which part of the curve you were in, if you actually took a deeper dive and a closer look into the name, you would have known that there was significant liquidity problems, issues at that company, and there was material default risk, and that's the part of the market that we want to avoid. So in summary, we're still constructive on US high yield. Recognize that there's this dispersion that's been playing out over the past 5-year period, which means that there's the importance of fundamental analysis, sector allocation, and security selection has been more important than ever for investors who are hoping to seek to generate superior adjusted returns. And then finally, I wanted to touch upon the new issuance market, which I speak in depth at our weekly meetings with our relationship managers. So July just gone was the 5th busiest July for new issuance on record. And even though it was the summer, investors are still hungry and still looking for yield from new deals. We had 24 billion of new high yield paper being printed, denominated in US dollars. That was over 33 deals. So companies are essentially taking advantage of the strength of the market, and they essentially want to get cheap financing. And there were 2 notable deals that came by. One was the broadcaster Sinclair, which issued 5 billion worth of debt through its subsidiary Diamond Sports in order to acquire the regional sports network from Fox Sports. And even though the company was taking on more debt, it had clearly stated plans that it wanted to reduce leverage after the acquisition. And investors really bought into that. And those bonds are already trading up over 2 points from the break. And then secondly, there was ADA, the packaging company, which refinanced 2 billion of its US denominated paper. And not only was it able to extend its maturity, but it was also able to reduce its coupon from 7% to 5%, again, highlighting the strength of investor demand. And the reason why I think the health of the new issue market is so important is because it acts as a barometer for investor sentiment, which it can play as a deal breaker for whether a company has to whether it's a highly indebted company is able to roll over its debt and live another day by kicking the can down the road, or having to go down the route of debt restructuring, potentially filing for Chapter 11 bankruptcy. So it's all in the hands of the lenders. And part of the reason, another part of the reason why we're focusing on the strength of the new issue market is because the default rates seen across the US high yield market has been trending below average through this credit cycle. It's just at 2.5% right now. So we're not particularly worried about default rates either right now. I'd just like to conclude by saying we're going to look at new deals opportunistically with a view to add exposure whenever we see that there's mispricing coupons. And we're going to do this as part of our tactical asset allocation strategy that we're forming at Dolfin. And with that, I'm going to hand over to Simon.
Just as before we crack on with Joe's topic, I'm not asking if you've smoked anything like this, but has anybody ever had, by a show of hands, taken any cannabis-derived product, CPD, given that we now have oil and a number of other products that Joe's talked about? Anyone want to volunteer that they've ever tried anything like that? There we go. So before I do let Joe loose, a friendly legal warning. You're going to realize when Joe has finished talking about what he's talking about, you're going to realize how ridiculous the situation is at the moment. And when you start to realize the range of products, the range of companies, the countries that are utilizing it, And then you start to realize the official UK stance. You can kind of see how this is not going to fit very nicely together. So according to UK law, investing into a company whose primary focus is on cannabis production, so it's something that you can do, especially if you're buying a Canadian listed stock. However, repatriating the proceeds of the sale of that Canadian listed stock back into the UK can be classified as proceeds of crime, which can be subject to 15 years in jail, according to the UK government and our laws. The chances of that ever being applied seem to be remote, but it is something that up until the current day, people that are investing into cannabis have to take into account when they are making those investment decisions. One of the issues that is rapidly cropping up is the number of companies across the world that have got investments into either products or other companies that are involved in the industry. So it is a little bit of, said, fun, hence the friendly legal warning, but it is something that people that are actively investing into do have to take into account. With that, enough from me, and I can pass you over to Joe.
Thank you. So before I start talking too much about the overall industry and trends, I'd like to have just one slide just to make sure that we all understand the difference between marijuana and hemp. I'd like to look at it in 3 ways to do the difference between both. The first one is more the composition of the plant and how it's used. The main components when we talk about cannabis is CBD and THC. When we talk about marijuana, we're mainly focusing on the THC molecule, which is this that makes you this sense of feeling high or euphoric. The usage of marijuana are medical, therapeutic, or recreational. That's the big difference. Whereas hemp, you're literally looking from it just from a medical and therapeutic perspective. But hemp being a very interesting plant, you can also use it for industrial purposes. For example, the US Constitution is actually written on hemp paper. From a legislation perspective, they're also very different. Since December 2018, hemp is now, has been scheduled away from the, hemp since December 2018 is now more or less legal, I suppose. And the US government is now technically subsidizing hemp farming. Whereas if you're wanting to plant marijuana, this is still illegal under federal law. Looking at global trends, so cannabis is the most widely consumed drug in the world. In the past 10 years, the consumption has increased by approximately 20%. Half of this is due to population growth, but the other half is just from a general acceptance of the plant globally. The estimates for the markets are quite wide. It goes from 50 billion to 500 billion. It's kind of difficult to estimate cannabis just because of how the different researchers on this will only look maybe at hemp, or they'll just look at marijuana. They won't take into account, for example, companies. And this one's gone as well, and it's back. Or they just they'll only look at companies who grow cannabis and then sell it, and they won't look at other aspects of the industry. The biggest markets currently are in North America, especially Canada and the US, as they've been as it's been legal for a bit longer than in other. And it's going again, and it's back. Okay. The European legislation is quite fragmented. We're seeing a positive trend similar to what we're seeing in the US and in Canada. But this is potentially looking at full legalization in the next 5 to 10 years in Europe. As the industry is getting more legal, companies are effectively allowed to meet consumer demands. We're seeing interesting trends of how the product is consumed. And we're seeing companies, what I like calling value-added products, which they transform the cannabis into different forms. Industrial hemp is also starting to attract interest because of the properties of the plant and how it can be used in different industries. The latest example was Canopy Growth, which is the largest company by market cap in the world, who's just invested 150 million in the New York State to start a plant which will be focusing on industrial hemp. So if today you were to invest in the cannabis industry, you'd be mainly investing in Canadian or American listed companies. The index and the ETFs that track the index, in my opinion, is something a bit delicate, as it is very the diversification opportunities. If you invest in this ETF, this is getting frustrating. I'll try with this one. Okay. And there we go. So North American marijuana index, the top 10 companies represent 73% of the overall index. What's interesting as well is that most of these companies are all producers and distributors of cannabis, and there's only one pure medical play. So if you're to invest in an ETF or just trying to track the index, the diversification is quite limited on this front. The whole industry is also actually driven more by news than by fundamentals. The big spikes that we see as often, and the opposite afterwards, comes just from big news. So for example, in July 2018, Coca-Cola announced that they were interested in the CBD industry and potentially looking to create a wellness Coca-Cola drink. At the end of 2018, we've seen a big fall in the overall index and company prices. This was due to just the overall sell-off, but also one company got shorted by a hedge fund. December was quite interesting at the same time because of the 2018 US Farm Bill. But during this month, we've had Altria, the big tobacco company, who invested into, I think it was Kronos Group, to start utilizing cannabis in their product. And at the same time, we had the Swiss pharmaceutical giant Novartis, who signed a 200 million distribution agreement with Tilray. So in the space of 6 months, we've had big tobacco companies being interested in the industry and big pharma companies as well. Hello, okay, back online. And the overall noise that started is obviously Constellation Brands, which decided to purchase 45% of Canopy Growth. That was the first really big deal that put the cannabis industry in the spotlights. Because of the shortage amount of data and well, not data, but because the limited time that these companies have actually been able to sell cannabis on a legal front, if you were to purchase any cannabis companies right now, it would actually be quite expensive. Some companies have been seen trading over 300 times PE. So it can get a bit tricky to invest if you're not, if you haven't really deep dived into the industry in general. So I'm going to focus a bit on the US, as we're kind of seeing legalization going west to east. The latest positive news that we've read was Illinois, which is the 11th and not the 12th, sorry about this, state to have legalized cannabis on a recreational basis. And last week in New York, decriminalized cannabis. Decriminalizing is quite a big step, as this actually, if you're in a state where it's not decriminalized and you're arrested, you go through the whole process. So you'd go to the police station, go to court, etc. The moment it's decriminalized, it's a lot easier for the police force and just for legislation to push forward. Because if you get caught with cannabis, most of the time you'll just pay a fine and then just walk away. The big question is, why are we seeing this, this positive trend? what's interestingly enough, what's interesting is looking at the different age group and how this has been accepted over the past 30, 40 years. So today, unless you're born in older times, sorry about the word, I don't know how to say it. Even though this trend has been positively increasing, most of the other generation groups are all in favor of legalizing cannabis and supporting it. What's interesting as well is the acceleration in this trend, especially after 2010, when we're kind of seeing all these US states legalizing cannabis. I think the first one was Colorado in 2012 or 2013. So, sorry. Oh yeah. What's interesting as well in the past 10 years is, so the UNODC, United Nations Office on Drug and Crime, every year perform questionnaires and see how many people consume cannabis. So in the past 10 years, past year cannabis has increased from 10 to 15% of the population. Just in the past 4 or 5 years, the same question has been asked, but the other question asked is how much have you been consuming cannabis on a monthly basis, on a daily or near daily basis? Since 2013, 2012, the actual proportion of people that have consumed cannabis on a monthly or daily basis has increased by around 50 to 60%. It's now estimated in the US that over 10 million people out of approximately 65, 70 million people consume cannabis on a daily or near daily basis. So this trend in consumption has also shifted towards how the consumers are consuming cannabis. We all have the image of cannabis consumers just rolling a joint and smoking it, but what we've been seeing in the past 2-3 years is this value-added product where companies are switching consumption, and it's going again, consumption methods to adapt themselves to what the consumer is wanting. So the switch has gone from just smoking cannabis as its raw form into a different form like edibles, oils. So in the past 3 years, less than 25% of the products were oils or vaping or edibles. And now it's over 35% of all sales are actually going away from the raw form. So this has actually a quite important impact on the companies that evolve in the industry, because all of a sudden some companies that have never grown cannabis and are only interested in extracting the oil to sell the oil or even to transform it into other products have seen their market share and their revenue grow more rapidly. Interestingly enough, these type of different products also have higher margins for these companies. So in the past 5-6 years, the actual price of the raw cannabis has more or less decreased by 50 to 60%. We're looking to from $13, $14 a gram going down to $5.5, $6. But the actual prices of oils and all these different products have more or less increased by 9 or 10%. An other interesting product that I'd like to talk about is the bottom left one. Having spoken to the ex-CEO of Canopy Growth, this was one of the main product that they were launching with Constellation Brands. Hello. So as he was saying, it's apparently a drink that's coming out this year in October. And it has the advantage of giving you the same euphoric feeling as alcohol. Hello. But apparently it doesn't give you any hangovers. So we'll see how this is quite a big step for Constellation Brands, because this was their bet really going into the cannabis industry. Now, going forward, we think that hemp is actually more interesting than marijuana. We think this because cannabis gains acceptance, we expect hemp to really separate itself from cannabis, and as this picture shows, the actual different products you can and industries you can work with cannabis is quite vast. At the moment, all the products are mainly using the flower or the seeds, but if you look at the stalk and the leaves, there's actually quite a wide range of products and industries you can work with. Just like looking at the hemp sales, so over 30% of hemp sales are actually for the industrial purposes. We're seeing in Western countries consumers being more environmentally conscious, and we think that hemp could help some companies touch these consumers. There's, interestingly enough, one major industry that hemp could help would be in the clothing industry. So some companies like Adidas, Quicksilver already have hemp-made clothes. Interestingly enough, I think it's 2.4% of global agricultural land is for cotton. Nevertheless, 10% of all chemical products is for the cotton industry, and it also consumes over 25% of all pesticides. To get 1 kilo of cotton, it consumes approximately 20,000 liters of water. To get the same amount in hemp to make clothes, this consumes half this amount. In the automotive industry, Alfa Romeo and BMW also use hemp in their doors. The advantage of this is that the product that's created is a bit stronger than doors made from petrol, but it is also 10% lighter. So they're getting, well, weight is always a big issue with cars, especially when you want to go faster. So this is another potential industry that hemp can help. Finally, the next big thing that investors are waiting for is the European market. So Prohibition Partners is a UK-based company, estimate that it's potentially the biggest market in the world. So they estimate in the next 5 to 10 years, it will be fully legal. I personally think it's going to be a bit less than this. So recently, Luxembourg has announced that it's going to legalize cannabis on a recreational basis. I think they're going to start voting the law this fall. So it's going to be legal in the next year or two. This is quite interesting, as very quickly you can kind of see the domino effect that this could have on neighboring countries. Luxembourg has over 200,000 workers who go into Luxembourg to work. You can imagine the issue this creates with France and Germany, for example, if you have all these people that drive through every single day and you have two completely different sets of laws. Europe is also a continent where the actual base consumers is higher than in Canada or the US when they started with. France has over 11% of the population who smokes. UK and Germany is 7.2 and 6.1. But again, if we assume the same trend that we've seen in Canada and the US, these figures are always slightly higher, and also the amount of consumption is also higher. In France, so we've seen the same as in New York, where they've decriminalized cannabis. I believe it was last year. Last week, again, they've announced that they're going to start a 2-year trial for medical cannabis. This is an interesting move in France. They've been quite 10, 15, and it's gone again. Hello? Yeah. Where was I? France, thank you. I think I'm nearly done on this. Oh yeah, so France, they're starting this 2-year trial, and the actual consumption base being hidden in other countries, I personally think that in the next 5 years, it'll become fully legal. And currently, as an investor, if you're interested in getting access to European cannabis companies, unfortunately, at the moment, the easiest way would be to go through listed Canadian companies which trade at high multiples because of the global reach that they currently have. Voila.
Thanks, Joe. We had given the rise in interest from clients, just to be clear, this is not something that we're pumping into our discretionary client portfolios, but it is something that we've seen a lot of interest coming in from clients, sometimes on the venture capital side, sometimes on the listed side. We did have the interesting conversation in the office of, can we consider investing in cannabis-related products from an ESG or an impact perspective? And the rationale there was, as Joe was saying, the decreased water usage on the growth of it, and the fact that there is already quite a lot of acceptance around some of the larger companies when they're looking for weight saving, cheaper, but if it's using less pesticides, fertilizer, water, then there is positive environmental benefits that are coming through. Any other questions? Perfect. Thank you very much, everybody.